When the government shuts down, the data goes dark. No jobs report, no inflation print, no spending numbers. And when official data disappears, the market turns to something else, the people who actually see the cracks forming first. And lately, those signals have started flashing. JPMorgan Chase & Company boosted its loan loss reserves by $810 million. Jamie Dimon warned of softening job growth, sticky inflation, and rising credit stress. Regional banks like Zions Bancorporation and Western Alliance Bancorporation have taken fraud-linked hits, and the collapses of First Brands Group and Tricolor Holdings have put lending risk right back in the spotlight. This time, the equity market noticed. The KBW Regional Banking Index plunged after those disclosures. Big banks kept rallying, but smaller lenders are under pressure, and that split is exactly how many credit downturns begin. Volatility is rising. More than $3 billion has flowed out of high-yield bond funds. Momentum trades like crypto are stalling. The VVX, the vol of vol, just hit its highest level since April. Traders are spooked. Risk managers are hedging again. But here's the key. This isn't a full-blown panic, at least not yet. If you look at funding markets, the SOFR lending range from the 25th to the 75th percentile hasn't meaningfully widened. SOFR, the secured overnight financing rate, is the key benchmark for the cost of borrowing cash overnight in the repo market, essentially the plumbing of the financial system. When credit stress goes systemic, SOFR spreads usually blow out as banks and funds charge each other more to borrow short-term. But right now, that spread is still contained. That means stress is real, but localized, not yet a funding crisis. And underneath it all sits a $1.7 trillion market that still looks calm on the surface, private credit. But calm doesn't mean safe. After Tricolor and First Brands blew up, BDC stocks, one of private credit's most popular fund structures, fell to multi-year lows. Spreads widened. Concessions on new bond issues more than doubled since January. Investors are waiting nervously for upcoming BDC earnings. As analysts said, we're flying blind. And that's because of how the game works. Private credit funds don't have to mark down loans when borrowers weaken. They can simply decide what those loans are worth. That's mark-to-myth accounting, and it hides volatility until it can't. Because private credit is embedded in pensions, insurers, and retail portfolios, when stress finally surfaces, it doesn't leak out slowly. It detonates. Meanwhile, stocks are priced for perfection. AI euphoria. Peak positioning, tight spreads. That's why even mild credit concerns, before they show up in SOFR, can be the pin that pops stretched valuations. With no government data, these real-time market signals are the macro story. Earnings calls, loan losses, fund flows, BDC cracks, regional bank stress, SOFR spreads. This is how credit cycles turn, quietly at first before the headlines catch up. If you want to stay ahead of that turn, like, share, and subscribe to Macro Pulse, Global Notes by JP. We'll track the signals while everyone else is still waiting for the data.